Before we start with the first and fundamental question on what is accounting and why study accounting and why you are in this course, let us take a step back and ask, what is a business organization? A business organization is nothing but a set of transactions, a set of exchanges. What are these exchanges that take place? The exchanges that take place can be between the company and a customer. This is a sale transaction. The transaction can also be one between the company and the supplier. This is a purchase transaction. Like that, there are a series of transactions that define an organization. Now, not all transactions are financial in nature, but there are many that are financial in nature, and those have to be captured by the company in order to know the performance of the company and in order to make decisions based on the performance of the company. So, accounting is the process of capturing the information in these exchanges or transactions, and that is referred to as bookkeeping or record keeping. So imagine that you are in a large firm and you are the principal accountant in the large firm. You will be responsible to make sure that every transaction that has a financial implication is captured properly in the records of the company. But this is not all. Bookkeeping or record keeping is only one part of it. The next part is that all these transactions are organized and provided to interested parties in a way that they can take decisions about the organization. Now, the process of summarizing and organizing these transactions and presenting them to the interested parties. This is accounting in the accounting cycle, and the presentation is done in the form of the 4 financial statements, which we will learn about shortly. The 4 financial statements are the income statement, the balance sheet, the statement of stockholders' equity, and the cash flow statement, cash flow, CF for short for cash flow statement. Now these provide information in a summarized form to interested parties. Who are these interested parties? They are investors who are trying to decide whether to invest in a company or not. They are lenders like banks who are trying to make a decision on whether to lend money to these companies or organizations. They are employees who are trying to make a decision on whether to work for this company and whether they will receive their salary in time with this company and whether this company has a good future. They are tax authorities the government to make sure that the company is not transgressing any rules, so on and so forth. Now, these interested parties are trying to take decisions about the company, and they can do so by the information provided in these four financial statements. Therefore, accounting is of crucial importance for keeping transactions properly and for taking decisions on investments, on lending, on working for the company, so on and so forth. I think now it is very clear why accounting is very important. One final point. What is the difference between financial accounting and managerial accounting? Financial accounting is geared towards external users, and managerial accounting, is geared towards internal users. So financial accounting for external users such as investors, lenders, employees, tax authorities, government. Managerial accounting is internal in nature, and it is all based on budgets and reports and plans and activities to make efficient decision making possible for the internal managers. That's why it's called managerial accounting. Let us now focus on the accounting equation. The accounting equation states that assets equals liabilities plus stockholders' equity. The goal in the next few minutes is to understand this equation intuitively. First of all, what is an asset? What are some examples of assets in our own life? You might own a car, or you might own a house, or you might even have some amount of cash which is your own. These are all assets or resources that you possess. Similarly, companies also have assets with them. Now, what the accounting equation tells us that the sum total of the value of these assets is nothing but the sum total of the liabilities plus the stockholders' equity in an organization. So, coming back to the example of a house that we may possess in our own life. So, I purchased my own house, which is my asset. I'm not very good in drawing, but I'm trying. And this costed me $200,000, for example. I did not have $200,000 with me, which is my own. So I borrowed some money from the bank. So the bank gave me some money. This is the bank, and the bank gave me some money, and let us assume that the bank lent me $170,000. Luckily, I had some money of my own saved as my own money, and that my own money happened to be $30,000. So I invested that $30,000 and then I borrowed $170,000 from the bank, and 170,000 plus 30,000 equals 200,000, which is what I invested and I purchased as an asset. So assets equals liabilities plus stockholders' equity. Now this is the fundamental accounting equation. Now, if you sum total all the resources of a company, that is the cash, the land, the other business truck or any other assets the company might have, total all of them, and then on the right side, if you show the liabilities that the company has or the borrowings that the company has, and also add whatever investments the stockholders have made in the form of uh, investment as stockholders' equity, then this assets should equal the liabilities. This all the assets should equal all the liabilities plus all the investments made by the stockholders in the form of stockholders' equity in the company. Now, this assets, liabilities, and stockholders' equity information. Where can we find this information about a company? We can find information about a company's assets, liabilities, and stockholders' equity in what is known as the balance sheet, which is one of the very important financial statements, the balance sheet. In the last slide, we saw how a company issues common stock and the stockholders invest stockholders' equity in a company. The company may also borrow money from lenders, and that is a liability of the company that it pays off in the future. So these liabilities and stockholders' equity are added together, and with these, the company purchases assets. These assets that are purchased by the company may include furnitures and fixtures, equipment, building, land, and these are all resources of the company that the company employs to generate revenues. So these revenues have to be recorded when the company records all its transactions. And at the end of the year, when the company is updating and um, um, recording or aggregating its books, these revenues are aggregated together and shown, and the expenses are subtracted from the revenues. Expenses, some examples are salaries expense, utilities expense, depreciation expense. We will see many more categories of expenses in the future. So these expenses are subtracted from the revenues in order to find out the bottom line of the company, which is the net income or the net losses. This is the most important number in a company, which is the bottom line. And this information is contained in the income statement. This is the next financial statement that you have learnt about. The first financial statement that you learnt about is the balance sheet, and the next financial statement is the income statement. The four financial statements that provide information in a comprehensive way to the interested parties about the performance of the company and help in decision making are the income statement, which by now you know contains the revenues and the expenses of the company, the balance sheet, which contains the assets, the liabilities, and the stockholders' equity of the company. And now we will see two other financial statements, the cash flow statement and the statement of stockholders' equity. Cash flow statement and statement of stockholders' equity. Let's now talk about another important statement, financial statement, which is the cash flow statement. As the name suggests, this talks about the flows or the inflows and outflows of cash in a company. And this statement is organized such that there are three parts. The first part talks about the net cash flows from operations. Operations means the day-to-day activities of a company. So the inflows that come from the day-to-day activities of a company are typically from the providing of sales or services. So when a company has cash sales or cash services, the company has cash inflows from operations. When the company purchases from the suppliers and pays cash, that would typically be a cash outflow from operations. And such information is provided and netted, and the net cash flow from operations is the first part. The second part of the cash flow statement shows the net cash flow from investments. From investments. A company might sell off all the old business computers and receive cash inflows from those sale of old business computers or long-term assets. Now, this is a cash inflow from investments or long-term assets. The company might buy new machinery and that would lead to a net cash outflow from the purchase of long-term assets or investments. So when you net the inflows and the outflows, you receive the net cash flow from investments. This is the second part of the cash flow statement. The third part of the cash flow statement is the net cash flow from financing. The net cash flow from financing has two parts, the net cash inflows and the net cash outflows. An example of net cash inflows from financing is when companies may issue common stock and stockholders invest in the company and there is cash infusion inside the company. That's an example of cash inflow from financing. The the cash outflow from financing, here is an example. the company may pay off its existing liabilities on long-term debt, and that leads to a cash outflow from financing. And when we net those, we get the net cash flow from financing. And when we sum total these three components, we receive the cash flow of the company. This may be a positive number or it may be a negative number. Now the question comes up, how is the cash flow statement different from the income statement? Well, the income statement captures revenues and the income statement captures expenses. Now, these are captured in the income statement and it includes credit transactions. What do we mean by that? Credit sales is included in the capture of revenues. Supplies purchased on credit is included in expenses. Non-cash expenses like depreciation expense is included in expenses. So the net income does not reveal the net cash that the company might possess. A company might have a positive net income because of a lot of credit sales. Yet the company might have net negative cash flow. So this is very profound and it is important to reflect on this, and therefore as a potential investor it is important to make sure that one looks at not just the net income of the company but also analyzes it in conjunction with the cash flow and see if that cash flow is positive or negative in the company. The statement of stockholders' equity has two parts to it. The first is the common stock and the second is the retained earnings. The common stock of a company is the investment made by the stockholders in the company, and this can be further separated into the value of common stock invested in the previous years plus the value of the common stock invested in this year in the company. So the value of the common stock invested in the previous years is known as the opening balance of common stock. And to this year's additional common stock issued is added to come up with the balance in common stock at the end of the year when the company is preparing the financial statements. Now we come to retained earnings. Retained earnings, as the term suggests, is the earnings of the company that it retains internally, and this comes from the balance of the retained earnings or the earnings that it has retained from performing its business over the years. So it is the opening balance of retained earnings plus this year's retained earnings. So what is this year's retained earnings? It is the revenues of the company this year minus the expenses incurred by the company this year minus whatever dividends the company might have paid to its investors this year. The dividends is optional, but often the company might have decided to pay some dividends as an appreciation for the stockholders to have invested their money in their company. So, therefore, recapping, stockholders' equity is the sum total of common stock plus retained earnings. Common stock is nothing but the value of common stock from the previous years plus additional common stock issued this year. And retained earnings is nothing but the earnings retained by the organization all these years of operation plus this year's revenues minus this year's expenses incurred minus the dividends that it may have paid out. So stockholders' equity equals common stock plus retained earnings, and this is the fourth financial statement. And the stockholders' equity, as you already know, is contained in the balance sheet also, and apart from being its own financial statement, which is the statement of stockholders' equity, the information or the value of stockholders' equity is also provided in the balance sheet when you look at assets, liabilities, and stockholders' equity. So we now know that the four financial statements are interconnected because the income statement contains the revenues and expenses. Revenues minus expenses. And in the statement of stockholders' equity, we just discussed that we show the common stock CS plus retained earnings, where retained earnings is defined as revenues minus expenses minus dividends. This is the definition of retained earnings. Of course, we have to add the opening balance of retained earnings to the revenues minus expenses minus dividends to come up with the final balance of retained earnings for the year. So, the revenues and expenses appear in the income statement and the statement of stockholders' equity. Now, look at the balance sheet. The balance sheet has information on assets equals balance sheet has information on assets equals liabilities plus stockholders equity. The statement of stockholders equity has the information that goes into this here. So the stockholders equity here is nothing but common stock and retained earnings. Thus, the statement of stockholders equity and the balance sheet are interrelated. And we further know that retained earnings has revenues, expenses, and dividends. The revenues and expenses also appear in the income statement. Finally, the cash flow statement. This cash flow statement has information on the net cash position of the company. Net cash position or balance. Now this information, can you guess where it would be? It would be an asset of the company. Cash is the most liquid asset of the company, and this is available here under assets in balance sheet. Thus, when we look at the four financial statements, the beauty is they are all interlinked, yet they each one of them provide some unique information.